Dirty dealings, corporate battles, consumer woes. This is Evening 5. Malaysia's economic growth accelerated faster than expected in the first quarter thanks to higher household spending, stronger investment activities and improvement in tourist arrivals. Gross domestic product grew 4.2% year-on-year, Bank Negara announced on Friday, which is higher than the median estimate of 3.9% growth in Bloomberg's Economist survey. According to the central bank, growth in 2024 will be driven by resilient domestic expenditure, with additional support from the recovery in external demand. On the demand side, private consumption rose 4.7%, while private investment climbed 9.2%. Public consumption gained 7.3%, and public investment was 11.5% higher. Net exports were down 24.5%. On the supply side, the services sector, which accounts for more than half of Malaysia's economic output, expanded 4.7%, and manufacturing activity advanced 1.9%. Meanwhile, Central Bank Governor Datuk Sheikh Abdul Rashid Abdul Ghaffur says BNM expects partial pension fund withdrawals to boost economic activity while having little impact on inflation. Specifically, he was referring to the recent introduction of the Employees Provident Fund Flexible Account 3, which came into being on May 11th. BNM kept its projections for headline inflation to average between 2 and 3.5% in 2024, as well as for Malaysia's economic growth to pick up to 4 to 5% in 2024 from a 3.7% expansion in 2023. BNM flags potential upsides to growth coming from greater spillovers from the tech upcycle, more robust tourism activities, and faster implementation of new and existing investment projects. On the flip side, downside risks include weaker than expected external demand, further escalation of geopolitical conflicts, and a larger decline in commodity prices. Abdul Rashid also reiterated that the current monetary stance is supportive of the economy and remains consistent with the current assessment of inflation and growth prospects. Tan Sri Mokhzani Mahathir will step down as the non-executive chairman of Maxis effective from June 30th, a position he has held for the past 15 years. While the board assesses potential candidates to succeed Mokhzani, independent director Datuk Hamidah Nazaidin will be appointed as interim chairman from July 1st. Maxis saw its first quarter net profit grow by 10% year-on-year to 353 million thanks to higher service revenue and cost control. Revenue for the quarter rose 3% year-on-year to 2.6 billion from 2.5 billion previously. It also declared a first interim dividend of 4 cents per share. Service revenue, which excludes sales of devices, grew 3.7% year-on-year to 2.19 billion in the first quarter. Service revenue at its consumer business was up 3.3%, while its enterprise business rose 6%. The blended monthly average revenue per user was 54 ringgit and 10 cents, down from 55 ringgit and 60 cents previously. Subscribers now stand at around 10.76 million, up 4.2% from a year earlier across the prepaid, postpaid and wireless broadband segments. Maxis spent 106 million in capital expenditure during the quarter. CEO Goh Seo Eng said that Maxis' healthy first quarter performance validates its integrated telco growth strategy. He adds that with focused investments in its network and digitalization, the telco is confident that it will continue to meet the connectivity needs of its customers. Maxis also reiterated its full-year guidance for a low single-digit increase in service revenue, EBITDA to remain relatively unchanged before any potential financial impact for 5G, and capex to remain under 1 billion ringgit. Malayan flour mill saw its net profit for the first quarter more than triple thanks to higher margins in its flour and grain trading segment amid lower wheat prices. Net profit spiked to 37.9 million from 10.4 million a year earlier, while in contrast, revenue declined 9.1% to 751.6 million on lower sales volume. Looking ahead, MFM said evolving geopolitical tensions and unpredictable weather conditions are likely to impact the prices of wheat and grain, but it will adjust selling prices prices accordingly and diversify the sources of wheat, corn and soybean meal. MFM is also planning to invest $100 million to install a new flour milling line with a capacity of 600 tons per day in Lumut after seeing improved utilization rate in its operations in Malaysia and Vietnam. For its poultry integration segment, MFM reported a share of loss of $1.2 million in its JV Dindings Tyson in the first quarter compared to a share profit of $15.3 million last year. The swing was attributed to the ongoing boycott of its quick service restaurant clients of Western brands and the discontinuation of chicken subsidy. However, MFM says the subsidy removal is a positive development for chicken producers once the supply and demand for poultry normalizes. It is also identifying new markets for its processed chicken. PPB Group is planning to invest $327 million in its film exhibition and distribution segment, which houses Golden Screen Cinemas, over the next 5 years. The company is looking to open 7 new cinemas over the next 3 to 5 years, 1 in Terengganu, 1 in Sarawak, 2 in Penang and 3 in the Klang Valley region, according to GSC CEO Ko Mei Lee. According to Ko, there is a lot more competition from other platforms, and as a result, the group is diversifying from just movies to F&B and events. GSC has previously stated that it aims to increase market share in key locations and consolidate selected locations that are non-performing or older cinemas. GSC closed 2 cinemas last year and another 3 so far this year, with a 4th shuttering soon. However, GSC has also opened 5 outlets over 2023 and another 2 year to date. Ko said the cinema operator is positioning itself to be able to capitalize on the growth when the market recovers, which it estimates will be in 2025 and 2026 when it gets more Hollywood content. The investment into the local and regional co-production, in fact, is to reduce GSC's reliance on Hollywood content, which saw its pipeline delayed as a result of the strikes that took place over last summer. Two years after it was listed on the ACE market, pawnshop operator Pappajack is seeking a transfer to the main market. The group said it has met the profit requirements for the move, having posted an adjusted PAT of $18.63 million for FY 2023 and an aggregate PAT of $35.11 million for the past 3 years. In a boss filing, Pappajack said it is in a healthy financial position, noting that it had recorded negative net cash from operating activities for FY 2022 and FY 2023 and has no accumulated losses. As at end December 2023, Pappajack's current assets stood at $272 million, while its current liabilities totaled 34.44 million ringgit. The group had cash and bank balances of 49.78 million and borrowings of about 38.53 million, with gearing at 0.16 times. Pappajack said the listing transfer will enhance its credibility and reputation and greater acceptance among investors. It is expected to be completed in the third quarter. Pappajack closed 2 sen or 2% up today to end the week at 1 ringgit 1 sen, giving it a market capitalization of 776 million ringgit.